ACCA with the Pro the journey of building strong concepts. The goal isn't just to pass the exam, it's to build concepts so strong that when you see the four answer option, they all might look similar, but you'll still be able to confidently pick the right one because you are the part of community which is Pro the journey. Before we begin, if you haven't watched part 1 and part 2 of the series, you can find them through the link in the I button. They will help you to understand today's topic much better. Now, in the part 3 of this series, we are going to cover what non-current assets are, how they are different from assets, when to capitalize and when to expense, asset register, which cost should be included in asset acquisition and which should not, depreciation, and finally disposal of assets. So let's get started. Hello everyone, welcome to this Pro the Journey YouTube channel. I'm Mr. Rai. I help you study professional knowledge in a simple and a practical way. So let's start. What are non-current assets? Now, let's talk about non-current assets. These are the assets that a business plans to keep and use for a long period of time. Unlike current assets, they are not brought to be sold as a part of everyday business's operation. Here's the thing. Non-current assets can be either tangible or intangible. Tangible means physically asset like building, vehicles, and machinery. Intangible means asset you can't physically touch, such as a patent, copyright, and trademarks. Businesses uses these assets to generate income. Sometimes they help directly, sometimes they support business operations behind the scenes. Another important point is that non-current assets are generally not very liquid. In simple words, they cannot be converted into cash quickly without losing a significant amount of value. So, whenever you think of non-current assets, remember they are long-term assets. They are not normally purchased for resale. They can be tangible or intangible. They help businesses earn income. And they are not easily converted into cash. Keep those points in mind because they will be important throughout this topic. Now let's move capitalization or expenses. When should a cost be capitalized and when should it be treated as an expense? Let's start with the capital expenditure. Capital expenditure refers to a money spent on acquisition non-current assets that will be used in business, not for resale. It also includes expenditure on existing non-current assets. When that spending increases, the asset earning capacity or performance also increases. The key idea here is that the benefit of the expenditure will be received over several years. That's why it's treated as a capital expenditure. Now let's look at the revenue expenditure. Revenue expenditure is mainly incurred to help generate revenue in the normal course of businesses. This includes costs to maintain the earning capacity of non-current assets, for example, repair and renewals. It also includes day-to-day operation. It also includes day-to-day operating expenses such as raw materials, administration cost, distribution cost. So remember, if the spending creates long-term benefit, it's usually capital expenditure. If it relates to the running or maintaining the business, it's usually revenue expenditure. Now let's understand what should to be included in the cost. Included in the cost of asset for capitalization purpose under IAC 16 property, plant and equipment. Here's a quick challenge for you. Comment below whether each of these costs should be included or excluded for the asset cost. Comment below whether each of these costs should be included or excluded from the asset cost, like purchase cost, delivery cost to bring the asset to the business location, repair due to damage, legal fees related to the asset purchase, training cost. And while you are at it, also comment the journal entry you think should be recorded when the asset purchase at the first time. We'll discuss the complete answer in the next video. Now let's move to the asset register. An asset register is a record that contains detail of all assets owned by the company. It helps management keep track of asset purchase date, location, age of assets, depreciation charged, accumulated depreciation, value of net assets, disposal details. In one place, you can easily see how many assets the company owns and their current status, and other important information for each asset. Now depreciation. What is it and why do we use it? Now let's move to one of the most important topic, which is depreciation. Systematic allocation of the depreciable amount of an asset over its useful lives. Now that's the technical definition, but what does it actually means? Simple put, depreciation spread the cost of an asset over the period in which the asset is expected to be used. This follows the matching concepts. The idea is that expenses should be matched with the revenue they help generate. Let's understand this with an example. Suppose Mr. Rai purchases an asset for $50,000. The asset has an expected useful life of 4 years and estimated scrap value of $10,000. Now think about it. The asset will provide benefits over all 4 years, not just in year first. So if the entire cost were charged as an expense immediately, two problems would arise. First, profit could turn into a large loss. Second, it could violate the matching concept because the expense would not match the revenue earned over the future years. That's why the cost is allocated systematically over the asset's useful life. Now let's have a look method of depreciation. Like different businesses may use different depreciation method depending on the nature of assets and business. One common method is the straight line method. Under this method, the same amount of depreciation is charged every year. For example, the machinery is purchased $50,000 with scrap value $10,000 and expected life is 4 years. So $10,000 per year is the depreciation amount. Another method is the reducing balance method. Under this approach, a fixed percentage is applied to the carrying amount each year. As the carrying amount reduces, the depreciation expense also reduces. Now the journal for this is journal entry for depreciation. The journal entry would be like depreciation expense account debit $10,000 to accumulated depreciation account credit $10,000. As a result, the carrying amount of the asset reduces. For example, an asset costing $50,000 would have carrying amount of $14,000 after charging 1 year of depreciation of $10,000. After understanding this, let's move to the asset disposal. Asset disposal. When an asset is sold, two outcomes are possible. The disposal value may be higher than the carrying amount, or the disposal value may be higher than the carrying amount, which is loss for a business. If disposal value is greater than the carrying amount, a gain arises. In tax terminology, this is often called a balancing charge. On the other hand, if disposal value is lower than the carrying amount, a loss arises. This is commonly referred to as a balancing allowance. We will cover this concept in more detail later.
For example, Mr. I having machinery carrying amount $500
and its market value is $600. Similarly, Mr. I having machinery carrying amount $500 and its market value is $500. So here it is profit. So here $600 less $500, it's profit of $100, and here $500 less $600, it's a loss of $100. Now here's an area students often found tricky. What happens if the useful life or residual value changes? Let's look at an example. Mr. Rai purchased a wood burning oven for $20,000 on 1st Jan 2001. At that time, the oven was expected to have a useful life of 10 years with no residual value. Then, on Jan 2004, its estimates were revised. The oven now expected to last another 8 years and have residual value of 1,200. What happened next? First, we calculate carrying amount at date of revision. Annual depreciation before revision. $20,000 divided by 10, which is $2,000 per year. For the first 2 years, the total depreciation is $4,000. Therefore, the carrying amount becomes $20,000 less $4,000 is equal to $16,000. Now the new estimates are applied. The revised depreciation will be $60,000 minus $1,200 divided by the useful life, which is 8 years. So the depreciable amount becomes $1,850 per year. Notice something important here? We don't go back and change previous year. We simply apply the new estimate going forward. That's a very important example, so make sure you remember it. Throughout this series, the goal isn't just to cover the topics. It's to understand the reasoning behind it. The deeper your understanding, the easier it becomes to answer exam questions confidently. And ultimately, that gives you a much better chance of passing while building concepts. That stay with you long after the exam, might help you to get promotion faster. So, you can also explore the ACCA practice platform. And if you want a separate video explaining how to use the practice platform, comment below and I'll make one for you. Our goal here is simple. No unnecessary theory, no boring PPT style teaching, just to increase watch time. We want to make accounting concepts simple, practical, and actually interesting. And if you want more practice video, let me know in the comment and I will see you in the next video. Till then, keep practicing, keep going.